Hi, I'm Gary Liu, CEO of the South China Morning Post. A lot has happened in the China tech space since last year. On the one hand, the underlying market continued to grow as the country added another 85 million internet users in 2020 alone. But on the other hand, listed Chinese tech companies have experienced a massive stock sell-off, losing over $1 trillion of market cap since February of 2021. That's more than Singapore's entire equity market, which is the biggest in Southeast Asia. So why did this happen? Following a period of rapid growth and innovation, the Chinese tech sector has entered a new phase with both push and pull factors forcing internet companies to evolve. Let's take a look at the 3 key trends that will be reshaping China's internet over the next year. China's tech industry has been hit by sweeping regulatory crackdowns since the second half of 2020. There was no shortage of headlines over the past 12 months, including the abrupt suspension of Ant Group's IPO, the record $2.8 billion antitrust fine on Alibaba, China's ban on Bitcoin mining, and the cybersecurity probe into Didi Chuxing shortly after its US IPO. By the end of July, the share prices of China's largest internet companies had dropped 30 to 50% from their peaks. The regulatory tightening is driven by Beijing's desire to better align the country's technology development with national strategic goals and public interests. The increased regulation has 4 main areas of focus: antitrust, fintech, data protection, and cryptocurrencies. But why? Let's go through these one by one. First, antitrust. China's internet industry is dominated by several tech giants. In some sectors, the market concentration is even higher than that in the United States. For instance, the top 3 players in China's e-commerce sector command 84% of the market, compared to 51% in the US. In food delivery, 98% of the market belongs to the 2 largest players. Ride-hailing is also dominated by 2 players, with a combined 92% market share, where Didi Chuxing claims the vast majority. Big tech's significant market power has led to monopolistic behaviors, like heavily walled gardens. Taobao is an e-commerce platform owned by Alibaba. WeChat is a messaging app owned by Alibaba's competitor, Tencent. Users are not allowed to share links from Taobao on WeChat. Imagine not being able to share a product link from Amazon on WhatsApp. Conversely, Alibaba often forces merchants to list products exclusively on their platforms, in a practice known as picking one from 2, threatening complete removal if merchants were to sell across multiple channels. What regulators are trying to do is to stamp out these monopolistic behaviors. Second, fintech. Fintech companies like Ant Group have been using big data and algorithms to facilitate borrowing by consumers and small businesses, but they contribute only a tiny fraction of the borrowed amounts, while most of the funding comes from banks. Such lending facilitated by fintech companies ballooned to over $500 billion in just 5 years. The government considers fintech to be fueling excessive borrowing and overspending, while bearing little of the liabilities. Therefore, it is now working to bring fintech under the same regulations as banks. Third, data protection. China previously lagged the EU and the US on data protection laws. Yet, public concern on rising privacy violations and the authorities' growing unease about the data practices of tech firms have accelerated legislation. Following the 2017 cybersecurity law, China passed the data security law in June of 2021. The Personal Information Protection Law is also expected to be finalized in this same year. China's legal regime on data protection is closely modeled after the GDPR, although it provides stronger protection of individual rights against corporations over state organs. Lastly, cryptocurrencies. Bitcoin mining consumes a significant amount of electricity, and China used to be the largest country in terms of Bitcoins mined and hash rate. At its peak in 2019, it was responsible for 76% of all the mining activities in the world. That share has since declined, but if we treat all of the Bitcoin activities in China as a city, Bitcoin would still be the 9th most polluting city in China in terms of carbon emissions before the crackdown. the environmental impact of crypto activities runs afoul of China's goal of achieving carbon neutrality by 2060. Separately, China is also keenly concerned about financial security and graft, as crypto has the potential of circumnavigating the country's strict capital controls. Chinese tech firms are facing increasingly difficult decisions on where to list their shares. Although the US is still a preferred IPO destination, thanks to its deep capital pools and flexible listing rules, the threat of forced delisting from the US is growing for Chinese companies due to the strained relationship between the two countries. As a result, we're seeing more secondary listings in Hong Kong as businesses seek to hedge against the risk of delisting. Newly public companies have also benefited from the relaxation of listing rules at the Hong Kong Stock Exchange. The Chinese government's recent cybersecurity reviews into US-listed companies, including Didi, and tightening scrutiny over future overseas listings are also further complicating the matter, leaving some startups' overseas IPO plans in tatters. The demographics of China's internet users are constantly evolving, creating new niche customer segments for internet companies. But in China, niche is enormous. The silver economy, the Xi economy, and sinking markets are now three of the most heated battlegrounds for businesses vying for growth. First, China has 264 million citizens aged 60 or above, but only 42% of them are now using the internet. This means an untapped population of 153 million, which is around half of the entire US internet population. As COVID-19 boosted the internet penetration among China's seniors, internet companies are eyeing the huge potential of the silver economy. Senior-friendly versions of mobile apps have been developed, featuring larger font size and simplified interfaces. Some even come with voice commands and screen reader functions for the visually impaired. Existing apps are carrying more content targeted at senior users. For example, short-form video platforms like Douyin and Kuaishou regularly promote elderly influencers. There are also new apps that specifically target seniors. As an example, Tangdou is an app that creates an online community for China's middle-aged or elderly square dance lovers. Second, a generation of well-educated, financially independent, and confident female consumers in China is propelling the growth of the so-called Xi economy. They are spearheading changes in consumption preferences with an increasing emphasis on personal characteristics and quality life. Take food and beverages as an example. Female consumers are pursuing healthier eating habits, lifting the demand for low-carb, low-fat, and high-protein snacks. There's also rising consumption across different categories of alcoholic drinks. More interestingly, traditional Chinese snacks are also experiencing resurgence among female consumers. Last but not least, internet companies are tapping into the under-penetrated sinking market. Chinese cities are categorized in tiers, with Beijing, Shanghai, Shenzhen, and Guangzhou being the Tier 1 cities. The term sinking market refers to the market of Tier 3 or below cities and rural areas, which together represent 78% of China's 1.4 billion population. One of this year's hottest business trends is the targeting of the sinking market for community group buying, which pulls together residents to purchase groceries and other daily essentials in bulk at a discount. In 2020, community group buying was boosted by the COVID-19 pandemic shutdowns as people turned to online grocery shopping. The transactional value of community group buying in China more than doubled from a year ago. Chinese tech and internet companies continue to impress with their growth and innovation, but they have now also entered a new phase of change. Given the sheer size of China's internet sector and its intertwined relationship with the global financial system, how these companies navigate evolving regulations and market fundamentals will have significant implications for the entire world.